Nicholas Bornos of Capital Link. We are almost at the end of an amazing forum today, full with tremendous panels and information. The title of the forum is Shipping, is it the Supercycle ahead? So we had before the panel from the investors who are investing in shipping and who gave us their point of view. And now we have a panel with ship owners. So I'm delighted to have such a tremendously high-level panel. I will turn it over to Peder Nicolai Jarlsby from Fearnley Securities to introduce our panelists. I'd like to remind everybody that we are hosting this event today in partnership with Fearnley Securities. We've been doing that for a number of years, every year now, and I would like to thank each one of the panelists for your participation and support. And Peder Nicolai, the floor is yours.
Thank you very much, Nicholas, and thank you for having me yet again. You mentioned the title of the panel, a Supercycle ahead, and I think if we rewind back to the early days of 2020, I think very few of us expected to stand here a year later with shipping firing on almost every cylinder, and have this topic as kind of the final panel of the day, the Supercycle panel. But I guess this goes to show that disruptions are normally good for shipping, and I think that's evident by what we've seen in the container space and also the dry bulk space in particular, where we have rates at decade highs or even record highs. We have a unseasonably strong LNG market. We've had a very good LPG market for years, even though it's not fantastic at the moment. And the missing piece is really the tanker industry. So I'm very happy to be here today with a very good panel with CEOs from all the key areas of shipping. I just want to give a quick introduction. First of all, we have Mark O'Neill, the President and CEO of Columbia Shipmanagement. From the LPG side, we have John Lycouris, the CEO of Dorian LPG. On LNG, it's Oystein Kalleklev, the CEO of Flex. From the tanker space, we have Hafnia, represented by CEO Mikael Skov. We have Constantin Baack of MPC Containers. And last but not least, Hamish Norton, the President of Star Bulk Carriers. So to kick things off, I would like to ask all of you and reply in about a minute's time to talk briefly about whether we are in a super cycle for your segment or not. And maybe we can start with you, Constantin. You are arguably in the hottest market of them all at the moment, the container market, which, it seems like we break new records every week. So are we in a super cycle, Constantin?
Yes, thanks, Peter. And thanks, obviously, to Capital Link for having all of us. Obviously, if you look at the key indicators for container shipping, this strongly suggests we are in a historically unique market environment. We have record high freight rates and volumes. We have record low idle statistics. Again, historical high TC rates combined with long charter periods. So all the ingredients that one would expect being present in a super cycle. Secondhand prices are going through the roof. We have, for example, just sold an 18-year-old vessel above newbuilding price. So this gives you a flavor of where we are. So looking at these key indicators, the container vessel market has never seen these extreme numbers before. So arguably, we are in a historic market environment. Whether it's a super cycle, it's a term that is often used. I think we are in a market that will stay very strong for the next 12 to 24 months in any event, looking at the supply and demand development. And as such, at these rate levels, I would argue we are in a super cycle. Back to you, Peter.
Thank you, Constantin. Over to you, Hamish. You were working in the on my side of the table back in the last super cycle, in the 03-09 period. Do you think that we're in a super cycle now, and do you see any similarities with what happened back then?
Well, I think there are some very moderate similarities. In some sense, it's history not repeating itself but rhyming. In the mid 2000s, that super cycle had to do with China increasing its demand for commodities faster than the shipyards of the world could keep up by building dry bulk ships. And for a period in 2007, the earliest dry bulk ship that you could get delivered if you wanted a new building was going to be built at a shipyard that at that point did not then exist. So that told you something about the demand. And of course, the order book got well over 60% of the total fleet, which was in retrospect too high. Now we've got a very different situation. Demand is increasing slowly but steadily. Supply is increasing almost not at all. And there are no orders for ships, or very few, even though rates are doing quite well and are projected to do quite well for quite a while. And why is that? It's because nobody knows what kind of ship to order. And that's true in tankers, that's true in container ships, but in tankers, you've got some charterers who are prepared to pay extra for an LNG fueled ship. So people are ordering LNG fueled tankers to some extent. And in the container business, the customers are getting so upset with the container lines that the container lines feel like in order to avoid violence, they have to order ships and increase their capacity. Whereas, in dry bulk, I think it's slow, it's steady, but nobody's going to order ships for a while. And by the time we know what kind of ship to order, it's going to be a few years to get those ships. They're going to be very expensive ships. And so rates will have to be high enough to support those new building orders if they're going to happen. I think we're in a super cycle for many years.
Thank you, Hamish. Moving over to you, Mark, and Columbia Shipmanagement, you obviously have a pulse on a lot of things that's happening in the market. Could you just take us through what you're seeing and what you think about what the future holds for shipping?
I think thank you, and thank you to Capital Link for inviting me onto this panel. I think I would echo all of the comments that have already been said. I think the only question that certainly our group had from the ship owning side of our chairman is how long is this super cycle going to last? And I think Hamish has hit the nail smack on the head. It is this uncertainty which will prevent this rush to the yards to build, even though the yards haven't yet got the capacity to do that. Ordinarily, they would have caught up perhaps in a very short space of time, and the super cycle would rapidly, like it has in so many times in the past, come to an end with an oversupply of vessels again. We simply don't know what is happening geopolitically. If we look at the world through a geopolitical lens, it's hugely uncertain. We don't know where technology is taking us. We don't know where the whole ESG environmental drive is taking us, what sort of ships will be required in the future, and what forms of propulsion will be acceptable, will tick the then ESG environmental box. We see that big operators like Maersk are hedging their bets and saying it's going to be methanol, or is it going to be LNG, or is it going to be hydrogen, and a combination? Nobody knows. And that uncertainty is good insofar as it puts a brake on what would otherwise naturally occur by way of knee-jerk, which is a splurge on new builds. And we're just not seeing that. So I think it will be a continuing super cycle going forward.
Thank you, Mark. Moving over to you, Oystein. The LNG market has been extremely strong given the season we've been in. It's been, some good days, very active with short, time charter markets. What do you think the future holds over the, call it, next half a decade for shipping?
I think it doesn't really feel like a super cycle right now, and that's maybe a good thing, because last time, back in 2006-07, capital was incredibly accessible. So all the banks were out providing capital and a lot of leverage. You could use like the financial markets to raise capital. Today, most shipping companies are trading well below NAV. So even though rates are going somewhere. It doesn't really reflect in the financial markets, and people aren't, also able to order a lot of ships. Ship capacity has been reducing for several years now because the yards have been losing so much money over the last couple of years. So I think that's kind of makes it better for the future, because capital is scarce. Shipping companies are being priced below NAV. The yards are not too eager to expand capacity, and I think that can create a super cycle. Whether we will be there, I'm not sure yet. It's too early to say, but there are certainly some good drivers there for the shipping market, with the supply of ships being low, and also both from a yard and a financial point of view. When it comes to LNG, we don't really have this propulsion puzzle, because the propulsion is very easy. It's LNG, you're just eating off the cargo to use for propulsion. So we do see some more ordering here in this space than the other segments, except for containers, of course. But that's also driven by the fact that you have a lot of older ships which are technically obsolete, and where we do expect scrapping to go up quite a lot in the near future.
Thank you, Oystein. And John, the LPG market has been perhaps the best one if you look aggregated for the past 6-7 years, but things are not horrible at the moment. Their rates are above cash break even. But do you think that we could, that you are going to follow the bulkers, the containers, and the LNG side, rate wise over the next coming years?
Oh, we hope so, to follow that. But LPG has been on a big cycle since the shale gas revolution in about 2011, 2012. We thought we were going to be on a big super cycle in 2005 and 4 when we built our first big ships, but it did not come out to be what ensued after that. The Middle East Gulf did not produce the LPG that we were expecting in 2006, 7, 8, and 10. But then the United States came in 2011, 12. Very small amounts of LPG started coming out, and now it has been on a super supply cycle where the United States has become 50% of worldwide production of LPG. So as such, I think LPG on the supply side has been a star performing commodity. It has become attractive not only to homes for cooking and heating, which is about 50% of the demand, but it also for the petrochemical industry. So I think it has proved to be a very important commodity to come into existence from 2013 onwards. And we expect that this supply will probably be followed by a big demand super cycle of this commodity, because it's becoming more widespread and it's a more attractive, cleaner commodity. It can be used on new buildings now as a fuel, effective from this year. It was a bit of a delay on that, but I think that's why we have seen also a big new building spree, because dual fuel ships built with LPG engines is a way going forward for the next 10 years at least. And then I guess transitioning into more carbon-free fuels.
Thank you, John. And Mikael, I saved you for last. I'm sorry about that, but I think it's well, there's no point of sugarcoating it, but the tanker market has been a big disappointment so far. But are you seeing any signs that things are about to turn for the tanker market as well?
Yeah, so I mean, I think the view that we have on the current situation is that as far as tankers are concerned, the cycle that we're just ahead to enter is going to be different than what we saw in the mid-2000s, which was very much, as Hamish I think mentioned, driven by a significant demand increase, particularly in China in general. We think this time, with a net inflow of below 1%, the next coming years of new tonnage, and the demand which we have seen, after post-COVID-19 lockdowns, how quickly demand of oil consumption actually comes back in these areas. These two in combination, I think, will give us quite a number of years of a very interesting market. But it's very much driven by low supply and what we just would see as normal steady increase of demand. So that's the difference. But I think it may even have a longer tail on it for some of the reasons already mentioned in this panel, which is that what do you order, particularly in the tanker industry going forward? Bigger ships with dual fuel engine, yeah, you can argue that can make sense. But for the product tankers, it's really only against long-term contracts. So, as most of the market is based on spot chartering and spot market in general, we see that this halt in ordering, has not only stopped. We also think that for the next couple of years, it's going to be difficult to justify building medium-range product tankers with dual fuel engines. It just doesn't make any economical sense. So that to us is really what will drive, we think, a very interesting number of years for tankers is really that low supply and the fact that it doesn't make any economical sense for medium-sized ships to have dual fuel engines at the moment.
Thank you, Mikael. I think moving over to the demand side of the equation, one of the big macro themes we've seen, one of the big themes in shipping so far this year has been the commodity rally, which we've seen, LNG and coal close to, decade highs. We've seen surging iron ore prices. And, it could seem like part of the, why we've seen this rally is obviously a combination of pent-up demand coming back, but also that, disturbances on the supply side. So maybe start with you, Oystein. Is there a case to be made that what's happening on the LNG side now could cause demand destruction further down the line? We've always talked about, LNG being cheap and accessible in order to penetrate new countries.
Yeah, I think definitely today LNG prices are too high. I would actually prefer if European prices were falling 30-40%, because today European LNG price is $20. It's $110 per barrel of oil equivalent. Actually, maybe 120. So the prices are too high. We do see more price-sensitive countries rather than burning coal or actually also fuel oil, including high sulfur fuel oil. But I don't think, if you look at the prices now, they are abnormally high, and they're going to probably stay high until end of the winter. So once you're getting into next year, we do see more normalized prices on LNG, even though they're still pretty high. And actually, we don't really see them trending towards more like the normal prices before summer to 2023. And this is due to a lot of different factors. So it's everything from hydro levels being low, wind blowing less than normal, which Wall Street Journal writes about today, and then less gas from Norway and less gas from Russia, pent-up demand, low inventory. So we really ended up in this perfect storm where just prices of LNG is going ballistic. Which is good for cargo owners. Cargo owners make a lot of money and they can pay more freight, But right now, of course, the prices in Europe are similar to Europe, and that's why the spot market's been a bit soft recently, because the spreads are not really there, and also most of the portfolio traders, they are long shipping because nobody really wants to be short shipping this winter, because this can blow up if we just have a cold winter, given the low inventory levels. But you will have some demand destruction until prices of LNG normalize, but that's not really a big problem today. You can sell LNG. If you have LNG, you will be able to sell it, that's for sure.
Thank you, Oystein. And maybe staying on the gas trail, John, we've seen on the LPG side, we've not really seen the same dynamics as we've seen on the LNG side. We've seen the Mont Belvieu propane price go to 120, and we haven't really seen a favorable price in Asia to allow for higher rates. Do you think, can you talk a bit about the demand situation you're seeing on the LPG side, particularly in Asia?
Oh, you're muted.
The demand has been very strong in Asia, and the pricing has been very high. But as we just discussed about LNG, LPG has been at similar kind of price levels. We have been hampered by the 2020 COVID situation, which kind of killed most of the production, and we are just about recovering production in the US Gulf generally, and we are seeing the supply coming back, and most of that supply is really going on exports. And the exports are very strong. We are seeing more than 80 ships a month being taken out, and Asia demand has been strong because Asia has been building PDH plants. The pricing has really not been very helpful, and with low inventories in the United States, prices will not going to go lower. It's exactly what Oystein said just a moment ago. We are facing exactly the same situation with low inventories going into wintertime. We are on the bottom of our 5-year inventory. We are on the bottom of how many days of supply we have. However, as I just said before, production is on the top side of the 5-year cycle. So we think that we are going to catch up at some point, but it might take until the spring of 2021, 22 to be able to come back into some kind of balance, and therefore more attractive pricing.
Thank you, John. And maybe switching gears over to the container side quickly with Constantin. There's been a lot of talk about the price of hiring vessels at the moment. We've seen some of the big liners already introducing rate caps, and I guess you can argue how much they are going to matter in the long term. But is container rates becoming too high for certain players in the value chain, or can you still live with the levels we have today?
Well, the rates are extremely high, and they are certainly, let's say, exaggerated due to the supply chain disruptions, right? If you look at the reliability of liner companies at the moment, it's less than 50%. So only less than every second box gets there on time. So I think this is a testament to where the supply chain is, right? And this is a mix between, the demand, the V-shaped demand recovery that simply had the boxes not where you needed them, and now obviously more and more tonnage being thrown on the market, which will actually exaggerate the situation. And in my book, it will definitely last well into 2022. And this is, if you talk to shippers, if you talk to liners, everyone is expecting that. You still have a situation where there's very low inventory levels in the US. A lot of growth at the moment, demand growth is actually, driven by the US. The rest of the market is not growing that much. It's growing, but not that much. But we obviously have, and a lot of the other panelists here have alluded to that already, a very tight supply side, right? And this is capacity being bound due to inefficiencies and constraints, but also the order book. And yes, in containers, there has been quite a significant ordering spree since Q3 last year, mainly very large ships, and not to be delivered in the next 24 months. So I think the rates will continue to be high. To your question on whether that will actually affect certain parties in the supply chain, yes, it might. But at the same time, the demand is there, and the demand will find its way. We have chartered out vessels directly to end users, to shippers, because of the reliability concerns they're having. And we're actually seeing, and I don't know if Hamish can comment on that, we've actually seen containers moving to bulkers, right? This is where we are, and this is a matter of very important to understand. Very good demand on the wrong side of the table, basically, and the disruption will continue. It will continue into 2022. It might leave certain parties off the table, but others are willing to pay up for what has been extremely low cost of transportation over the last decade. And I think we're just there where it has to be, maybe not at the accelerated levels, so at lower levels, but certainly at higher cost of transportation, what we've seen compared to the last 10 years.
Thank you, and that was a good transition to Hamish. You know, we've seen coal and iron ore; they obviously come down from the peak levels, at least iron ore. But are you seeing any risk that could kind of derail some of the economic growth going forward and kind of have negative implications down the road for the dry bulk market?
You know, we're not seeing any negative signs. You know, basically, you know, there may be slightly less demand for iron ore in China, but there's more demand for iron ore elsewhere. And, you know, frankly, we see the limit on iron ore shipments as being the amount of iron ore production, you know, especially in Brazil. But Brazil seems to be ramping up. And, you know, coal demand, again, seems to be quite strong. You know, coal-generated electricity that seems to be required because there doesn't seem to be enough, you know, wind, solar, hydroelectric power, you know, to generate enough electricity to satisfy demand. So, you know, it's all is looking good. And of course, grain is looking quite good. So, you know, we see demand basically growing relatively steadily, not, you know, not like the container business where demand, you know, took off, but just a nice steady increase in dry bulk demand. And, you know, I think it's been very helpful that when economies want to be stimulated, or when governments want to stimulate their economies, they tend to do it with infrastructure spending, at least in part. And that, of course, drives demand for dry bulk.
Thank you. And I think that's an interesting point you make in terms of solar and wind. And there's all this talk about, you know, renewables. Could it be, you know, a case that the investments and energy required to build out both solar and wind power will keep commodity prices higher for longer? Is that a case to be made? And I don't know if you want to answer, Hamish, or anyone else on the panel.
Well, look, I won't give a definitive answer because I'm frankly not an expert, but it is certainly the case that wind power and solar power, to build out that capability, will take, at least for a several year period, a very large amount of commodities shipped around the world. So it's got to be a significant effect. And, you know, the wind and solar power will also need storage of electricity. And that's going to take, building out the electricity storage is going to take a lot of commodity shipment as well.
If I could add to that as well, I think through our MPP fleet, AAL, you know, we're seeing not only the installation of further wind turbines, but of course, this is a time as we come out of the pandemic over the next year, 2 years, that's often been compared to the Roaring '20s. There's a huge energy to renew and restructure and rebuild alongside a number of states that were at that point of development in any event. So I think, you know, even the existing infrastructure
I think he got too excited.
Or perhaps the infrastructure let him down.
Needs to buy more copper.
All right. While we wait for Mark, I think we can jump over and discuss a bit about the supply side. And I was going to direct this question to Mark, but I think we'll have to wait. But I want to talk a bit about congestion, and it's seemingly been helping a lot of these markets. And Mikael, I want to just ask you first: are you seeing any type of congestion in the tanker market, as we've heard of on, you know, in the dry bulk or container space, that could, you know, perhaps be hidden supply once they return to the market, or is it, you know, limited impact of that in the tanker market?
Yeah, so we're not really seeing any effect of any form of delays at the moment. So I don't think that in itself is going to have any impact. I think, you know, the key issue really from the tanker side is, so demand is of course one, which is very much about transportation, people flying, driving, etc. That we're still short of 3 to 3.5 million barrels per day of demand. But I think the key element here as well for oil is that, you know, the last 9 months has basically been spent in drawing down inventories, you know, to way below 5-year average. So I think the market has set itself up for a very vulnerable situation. So what you're probably going to see is that whether it's a seasonality, whether it's any form of disruption, I think right now the tanker market, and it may look a bit weird considering where the rates are, but it's getting tight. And as we are delivering a finished product, it doesn't take much of a disruption or seasonality really to start transportation again, because you're not going to be able to draw any more from inventory. So I think that's kind of our caveat if you talk about an element or a factor that can very quickly get the market to move.
Thank you. And maybe moving back to you, Constantin, there's been a lot of things written and said about the congestion and supply chain disruptions in the container market. But you know, could you just is it possible to quantify the impact it's having, and you know, maybe comment on how long you see these supply side factors continuing to have a positive impact on your market?
I think it's very challenging, and I mean, people have expected that this year Chinese New Year would be the D-date when things will normalize. You know, then you had additional effects. I mean, we had the Ever Given, we had Yantian, we had Ningbo, you know, and then we had a demand growth due to the V-shaped structure of the demand development, of the volume development, that completely, you know, distorted the picture. So if you look at, and then in May, people thought, you know, congestion, for example, in LA, Long Beach went down. So people thought, well, this is the end. So it's now going to be sorted out. And now we're at an all-time high, right? We have vessels at anchor in the Americas, so more than 130 vessels in the total region, right? This is not just LA, Long Beach, but this gives you an idea how much capacity is actually kept. And I think the question is also that the vessels find alternative routes. We have a 2,800 TEU ship on an east-west route going from China to the US. The vessel doesn't fit there, right? I mean, it shouldn't go there. It should be transported, boxes should be transported by much larger vessels. So these vessels need to be phased in, phased out into services. And that's why I think there will be a prolonged period of disruption. It'll take time until things normalize. In addition, we still have, and that's a very important factor, and it's being addressed in the US, in fact, we have the infrastructure issue, right? I mean, automation of ports in Europe or elsewhere is standard. In the US, it's still a lot of, you know, manual work. And then you had the disruption due to COVID that causes a lot of delays. So all these things will not be changed overnight. We have larger and larger vessels. See the Ever Given. I mean, larger vessels, if a larger vessel has an issue or if there is a constraint in the schedule, it will simply have more knock-on effects. So looking at volumes, looking at what shippers are prepared to commit, also in terms of longer-term commitments vis-a-vis liners, or even chartering in ships from tonnage providers like us, I'm personally of the expectation that this disruption will definitely last well into next year. And that's a challenge for the industry, but unfortunately, it is what it is.
Thank you. And Hamish, I know you're very good with numbers, and there's a lot of talk with you know, both impact from the containerized trade going into dry bulk. There's the congestion seen in China. Do you have any numbers you can attach to those two things, or is it difficult?
It's difficult to attach numbers, but I will say that there's a big, you know, COVID is having a big impact on congestion. You do have a number of vessels waiting outside ports for, you know, a certain number of days to elapse since they've been at the last port before they'll be allowed in to discharge. And of course, you know, there's another effect, which is we still have to divert ships to the Philippines sometimes to change crew. You know, we not as much as before, but it's a pretty big impact. You know, and then, you know, just normal port congestion from having, you know, in a certain period of time, more stuff to discharge than can be discharged, or more stuff to load than can be loaded. And, I don't think this is going to start to normalize until the demand for massages reaches its, think about, the demand for massages worldwide. That's an indication of when we'll start to see the shipping industry sort of get back to normal. That's when tanker demand will pick back up. That's when demand for, stuff shipped out of China will come back down to sort of normal levels. And when, port congestion for dry bulk will probably return to more normal levels. But I'm optimistic for dry bulk even after the demand for massages normalizes, because again, we don't have a good reason to order ships, and demand just keeps growing slowly and steadily.
Thank you. I'll make sure to introduce a graph on that in our next shipping weekly as a shipping indicator. Mark, just I know we lost you for a few minutes, but just very briefly, could you talk about what you're seeing on the congestion side, maybe across the various segments? If you have anything that you
I thought I'd joined the wrong seminar actually when I heard about the demand for massages. I thought the conversation has really galloped on while I lost. Apologies for that. Look, I think congestion, of course we're seeing a congestion across the board, and Hamish touched on it there. I think operationally, alongside this super cycle, a huge operational concerns that we have, certainly on the management side, and I'm sure it's across the board. We had vessels that were having to be extremely economically managed prior to COVID, because shipping was in a very different economic space, then being hit by COVID, and our inability to get boots on the decks as far as surveyors are concerned, etc., and really ensure that maintenance was taking place on board the vessels by very worried crew who over their rotational periods, etc., and perhaps not in the most motivational place. I think these are operational challenges alongside the continued rotational issues that we're having that can't be underestimated. Will that stop the super cycle? No, it won't. But shipping is amazingly adept at dealing with these challenges. We don't call them problems, and deal with them we will. But the vaccination, crew rotation, outstanding crew rotation, congestion are huge operational issues which threaten the growth of the sector overall, irrespective of all the dynamics being very much positive.
Thank you, Mark. And I guess we can't have a shipping seminar in 2021 without touching on regulation. And I want to talk or ask you, Oystein, you've in the LNG segment, I don't think there's been any segment that's been more technological progress over the years. There's a lot of older vintage vessels. Just with all the new regulation coming, how do you see the impact on the LNG market? It's obviously the order book in LNG is quite big. That's a lot of it is tied to projects, but then you have this potential wave of phase out. Just curious to hear what you're thinking around that.
Oh, it's our main business thesis has been ordering the new ships when shipbuilding prices were low in 2017 and 18. So we bought these ships for $185 million. Today, new building price $210 million. So these are the new ships. We got the last ship delivered in May, and so all the 13 ships are on the water. And of course, the reason for doing that is because of this technology progress we have seen, going from having the least efficient ships in the industry with steam propulsion, which the tankers left back in the 70s. And those ships are still 200 of those on the water. So we do see now with EEXI and the carbon indicator regulation coming into force in 2023, that certainly there will be a phase out of the steam ships. And our thesis all along has been those, once these ships are coming off their legacy long-term contracts and rolling off those, they will not be renewed but replaced. And that's why we haven't been worried about the order book, because there is a lot of pent-up scrapping in this sector, and we do think that a lot of these steam ships will certainly have problems with the new regulation in terms of emissions. And also right now with these high LNG prices, this ship I have behind me here, it consumes 60% less CO2 fuel per cargo. So if you have LNG prices at $20 per million BTU, and you have a ship which is almost 60% more efficient, of course you can pay a higher charter rate for that ship as well. So that's why we are have a positive outlook on the market, because there will be a lot of ships being scrapped out of the market. The first ships to go are all the steam ships built before 2000, and then all the steam ships being built after 2000. And there are some other of the ships in the industry that will also have some problems facing this 40% reduction in carbon intensity by 2030.
Thank you. And I think while we're on the gas side, John, just very quickly, I think a lot of people have been surprised to see the amount of ordering that's happened on the VLGC side this year. Why do you think we've seen so many orders? And do you see kind of the orders that's been placed? Are there any natural phase-out candidates in the VLGC market?
Well, all the orders have been for dual fuel ships, so that kind of speaks for itself. Why there are so many orders. The first engines came out earlier this year. As a result, people felt more comfortable ordering ships for dual fuel LPG. They will be able to transition all the way into probably 2030 and beyond. Their performance, of course, they qualify for EEXI, and also they will be able to trade with the CII, with their speed and consumptions. They will be able to trade with CII tightening every year into 2030 and beyond. So I think it was something that everybody was waiting to happen, and finally a decision was made to progress into dual fuel ships. And I think that would mean that some of the older ships in the fleet, about 30 or 40 ships that are very old, have high consumption, smaller capacity, will probably have to be retired. And I think that's what really made the difference this year on the LPG sector.
Thank you. And you know, we need to touch upon the equity markets, and I think we can do that kind of in tandem with the discussion on regulation. But shipping has obviously been under a lot of scrutiny in recent years with regards to emissions, and I guess one obvious reason why we haven't seen investments in new ships has been the uncertainty of propulsion. Another has been lack of capital. Shipping has not been a party for the past 10 years. But now that many companies have a lot of free cash flow, how do you think of investing for the future and also short-term gains to investors that are in your equities? Now, I'll just kind of leave that to the floor, whoever wants to take it. But how do you kind of match investing for the future with the short-term dividend focus that many investors likely have?
Well, I guess what Star Bulk is doing is basically delevering to the extent that our bank debt amortizes normally, and it amortizes fairly rapidly. So we pay that amortization, so we're delevering. And then with the remainder of the cash, we're paying a dividend right now. And we are consciously leaving the job of renewing the fleet, which we will have to do, for a time when we know what we need to order and we are able to order it.
I mean, look what, if I can mention, look what happened to the scrubber argument. Those that jumped in and ordered scrubbers and fitted scrubbers, there is a question whether that will ever pay off. Does an investor look at the shipping space now with the high cost of these dual fuel vessels, a high cost of technology, and make an investment comfortably. No, I think what we will see, and much wiser heads than I have said it, that you will see the existing fleet trading longer, trading on low sulfur, trading with all sorts of carbon capture technology, trading with perhaps battery packs on board for the last 10 kilometers in and first 10 kilometers out. We will see these vessels trading for longer, much more in a much more environmentally friendly way than that they're doing now. But that's the answer, because there is no one solution yet. And at the very best, we'll have a multiple number of propulsion solutions for the next 10, 15 years, which is not investor friendly. You know, it's a big call to plumb for methanol. It's a big call to plumb for LNG stroke electricity or sulfur, low sulfur. So, you know, it's not an investor friendly environment.
Thank you. Maybe touch upon you as well, Constantin. You're securing more and more backlog every day at fantasy rates. You're not generating that much cash flow today, but as we move forward, that cash flow is going to come. Are you tempted to kind of go out and renew the fleet? Or I know you acquired the Songa fleet, but you know, in terms of new builds, maybe replacing some of those older vessels in your fleet. Just curious how you think about, you know, dividends that obviously a lot of investors have been waiting for, and the fleet renewal.
Sure, and I can to some extent echo what Hamish has said on taking the right decision at the right time, right? And then I personally think it's not the right time to order new builds, at least for us. We believe that we have a age profile in our fleet which actually matches very well my expectation on being well positioned for an energy transition, right, in terms of renewing the fleet. So our average age is 13, 14 years of age. We have basically, by the end of this year, we will have de-risked our enterprise value by cash flows and scrap. I think this is a very attractive proposition, and that on the back of very, very low leverage, right? So we would also optimize our balance sheet structure on the back of our EBITDA backlog, de-lever the company financially, and then look at a significant dividend to return to investors. And this is the game plan that we have also communicated earlier this year. We still need to do a few tweaks on the balance sheet in order to be there. But on the back of this significant cash flow backlog, I'm very confident that we will be getting there. And the priority is to return capital to investors. And given our backlog, we would still have enough, even if that was a majority of our free cash flow, we would still have a significant cash available for fleet renewal when the time is right. And the time is not right at this very moment. We're obviously very carefully observing the market and the options out there. And that, I think, is in line with what Mikael said earlier on the smaller vessels. On smaller container vessels, also dual fuel options or all these kinds of gimmicks, they do not economically make sense. It does make sense on larger container vessels. This is why we have seen an ordering spree there. On the smaller units where we have our basically home turf, it doesn't really make sense. And this is why we have also not seen that many orders. So we will be very rational and prudent on our capital allocation. We will return capital to investors, de-lever the company. And I agree with what Mark has said as well. There will be more a life cycle approach to using vessels. We would rather invest into some of our vessels where it makes sense to optimize them from an emission standpoint and extend the useful life, because that, in my view, is the right way to approach the current market and environmental environment.
Thank you. There's been a lot of talk about a super cycle, and I think Oystein alluded to this earlier today, that there is a bit of a disconnect in terms of perception that we are in a super cycle and where the equities are trading, because to my recollection, at least, all of you are trading below, or close, or most of you below a net asset value, which makes little sense if we're actually in a super cycle, because that you should by proxy have shares trading above net asset value. Any comments on that? How you guys are being priced by the equity markets at the moment versus the steel values?
Well, in our case, we don't try to pay much attention to the share price. But, I think that when you're paying a dividend, I think people want to see it happen for a few times. And I think the more often they see it happen, the more comfortable they get that it's going to happen again. And, you know, I think that probably will give confidence to the investor base.
Thank you. And
We
maybe
pay attention to your stock price, and that's why we've been buying back 1 million shares since November, because it's been crazy cheap. So we told people, you know, it's Black Friday pricing on the shares, and people didn't pick it up. So then we started picking up the stock. So last 12 months, we distributed 96% of our earnings, mostly through dividends, but also some buybacks then. And that's our plan going forward as well. And we're guided that revenues will go up in the second half of the year. So potentially it's for higher dividends in the future. But we don't look at the stock price when we are investing shares. If you look at the stock price when you are investing in ships, you're always going to do the wrong thing, because you're going to invest on the peak. And that's been the problem with a lot of listed shipping companies over the years. They always invest at the peak, because that's when their share price is high and they can issue equity, because also the capital markets are more liquid. So we have done the opposite. We invested in ships a couple of years when they were much cheaper than today, and now we're taking delivery of those ships, and now we're harvesting the cash flow and paying it out to our shareholders.
I think in terms of, you know, we've seen asset values soar, even on the tanker side, Mikael, where earnings, you know, have been, as I mentioned earlier, it's been absolutely horrible. Have you considered selling assets, you know, given the backdrop we've had with loss-making earnings and really strong asset values, to kind of bridge that gap to NAV?
Yeah, absolutely. But, you know, again, that's more been part of a, you know, a fleet renewal strategy, if you like. So we have been selling off some older assets, but again, you know, we don't buy and sell ships either just in the bag of you know, a share price here now. I think it's fair to say, talking about the equity market and why we've been trading low in general, is that, you know, the shipping market has been crying wolf for quite a number of years, and nothing really happened. And if you go back in 2015, for instance, also in tankers, there was a very high expectation that a really high freight environment was going to move share prices and asset values up, but it never happened because nobody really believed it was sustainable. I think this time around is slightly different. We're actually seeing asset values moving up before earnings. So, you know, I think fundamentally, you know, the fact that we do have that supply scenario that we talked about earlier, all of us, I think is also giving investors, you know, a belief that this might be different. But I think also, you know, more importantly, I mean, it's so important that the companies that are spot market focused has, and I think the last couple of years have actually proved this, has a long runway. The thing with shipping is that you can't gear up and be aggressive towards an expected spot market upturn is going to happen within the next 6 to 12 months. Everyone that's tried to do that has failed. I think what investors need to look for is that long runway, but when the payday comes, as we've seen in containers and dry bulk, it comes quickly. I mean, who would in September last year expect the dry bulk market to be where it is? Very few people. And I think this is the thing about shipping, is that if you have companies that have a long runway, they will be there when the market is there to harvest, right? And I think this is probably one of the key components, I think, for investors to look out for.
Yeah. And I mean, just getting, Peder, to your question about regulations, you know, we think the decarbonization regulations are going to be really helpful to the shipping industry for a long time, because, you know, the decarbonization regulations will require that the fleet basically completely turn over at great cost, because the ships that people will order will be very expensive ships. And yet people won't be forced at gunpoint to order these ships. They will be economically compelled to order the ships. And what does that mean? It means rates will be high. They have to be high in order to turn over the fleet and get the fleet that is demanded by the upcoming regulations.
Thank you. Any further comments to that from our panelists? All right. I guess we have room for one more question. Let's see, we have 5 minutes left, but I think you're onto something in Hamish and also Mikael in terms of the perception of shipping could potentially change now. What we have these regulation coming up, but we also have had an issue in shipping for a long time, which is leverage, as Mikael pointed to as well. Is this a opportunity for you? Maybe direct this question to Oystein and Constantin first, but to kind of just delever fully and have a company that is, capable of paying dividends over the cycle, as Hamish has alluded to on the Starbull conference calls in the past?
Well, when I went to business school, we learned that, equity is a pillow, debt is a dagger. If you don't have any debt in the company, you will have lazy management. And I still believe that. That's why we have the leverage. And we're not planning to reduce leverage beyond what we are paying in amortization. And of course, the amortization of our ship is much quicker than the economic life reduction. So we feel comfortable with that. So we rather focus on dividends. And also, if you have some leverage and you're paying dividends, then management will also stay awake a bit during the night, because they know that they have to pay this dividend and also pay the debt. And of course, the debt is cheaper. But of course, you have to engineer the level of debt towards your business risk. So if you have a very high business risk, i.e. being fully spot exposed, then of course you need lower leverage than if you have a bigger backlog. So what we have been doing since April now is to add a lot of backlog to our company, and that enables us to pay more dividend. But the leverage is going to stay the same, except for the normal deleveraging through amortization.
Thank you, Constantin. You have a comment?
Sure. I mean, it also depends on where you are with your company and your fleet age, etc. Right? I mean, we have let's say 13, 14 years old vessels. We are in a market where we earn a lot of money, so we have a very high operational leverage. Adding financial leverage provides flexibility in your capital allocation decisions in a certain way, but we believe that going into the next 10, 15 years, where there will be a lot of requirements from companies, to have a moderate to low leverage is clearly a beneficial element in my view, because you simply have more flexibility going forward. And that's why we will definitely adhere to a low leverage strategy. That doesn't mean no leverage, clearly, because there I agree with some of the comments that Oystein made just now. I mean, there's no purpose in having no leverage. I mean, leverage optimizes your balance sheet structure to the extent that it doesn't at some point, right? So you have to be very, very careful. We will adhere to a low leverage strategy and make sure that we have all the flexibility to take discretionary capital allocation decisions going forward, including a high dividend and including also potentially making use of accretive acquisitions. So low leverage, not no leverage.
Thank you. We have time for one more reply to that. There's about a minute and a half left. So if anyone has any comment on the leverage side, please go ahead.
Well, on Dorian, perhaps we should say that Dorian has just paid a dividend for first time. And we sense that dividends may be a way to help investors in a return of capital. We have already done tender offers. We have bought shares back, and we have kept our leverage low, below 40%. So we think we've done everything that we can as far as corporate management is concerned, in trying to return back to the shareholders the best value for their investment in Dorian LPG. So we hope to see benefits out of that approach. And also we have something to touch on. S&P, we've sold one of our ships to one of the oldest in return for a new ship that we have ordered. So trying to be measured in our ways of looking into the company and trying to keep a low leverage, because I think in the future we all will probably have to invest in our vessels for the future regulatory requirements. and make sure that our vessels perform a lot better, perhaps install carbon capture or things like that before we do go to nitrogen or ammonia. So.
Thank you, John. I think we're just on time there, so I want to thank all the panelists for joining us here today, and I'll give the floor over to you, Nicholas.
Well, thank you very much. This is a terrific way to almost conclude the forum. We have one more closing remarks coming up, but I have to say this has been an amazing insight. Thank you. We have the leadership of major companies from different sectors, extremely compact and comprehensive. So all I can say, a tremendous thanks. And I'm delighted, frankly, that we have been able to hold such a great event within the London International Shipping Week. Thank you to all of you.
Thank you.
Thank you.
Thanks, Nico.
Yeah.
Thanks.
Thank you very much.
Thank you.
Take care.